Welcome to Subramani. Some more gyan on investing, or rather investing lessons. I keep doing these quite often. It's more for myself than for you, right? So first, remember the most important adage in life: this too shall pass. So if you're very euphoric, if you're depressed, whatever, doesn't matter, this too shall pass. Markets will go up, markets will go down. When markets go up, we think market can never come down, and when market is down, we think market can never go up, and we will have fantastic reasons for it, right? Oh, Modi did not get a third term, so now the market will stay down. Nothing like that. The country goes on, immaterial of what happens to prime ministers and chief ministers, etc., right? 20 years back, we did not know that we would have a prime minister called Narendra Modi, right? Maybe 20 years back, we did not have that UP, we did not know that UP will have a chief minister called Yogi Adityanath. We were going on in life, and then some people came, they made some transformational changes, which was fantastic, and we have grown. Does it mean the same thing will continue? I'm not even getting into whether the same thing will continue, but India will continue. Under a different prime minister, under a different chief minister, everything will happen. So don't worry, if this too shall pass. Don't be euphoric, nor be too much worried what happens if this continuity is not there. If one goes and another comes, nothing really changes in the life of a country, right? So this too shall pass is something which is important to remember. Second thing to remember is the most important thing in creating wealth is survival. You have to live through it. Now, can you imagine how much wealth Rakesh Jhunjhunwala would have had if he had lived for another 40 years, like Charlie Munger, right? Rakesh died at 62. He could have lived, Charlie Munger is 100. So another 40 years of compounding. Can you imagine what it does? So if you take Buffett's wealth, Warren Buffett's wealth, it is obvious that it is the magic is N. It is not just the R. Of course, the R is very good, great maybe, but the magic is the N. 80 years of compounding or 82 years of compounding is not any of us will ever get in our lifetimes. It is impossible. So whatever you do, so many years of knowing how to do it and actually doing it and delivering it is not going to happen for everybody for such a long period. So if you are wondering where wealth comes from, it comes from N. So if you take the Birla group, it is 170 years of compounding. If you take the Bombay Dyeing Wadia group, it is again about 190, 200 years of compounding. Same thing for the Tata group. It is the N which matters. R, of course, has to be good. R cannot be negative, then you can ruin your wealth, right? I've done videos on how wealth is ruined in families. So I'm not saying that can't happen, but the most important thing is N for a long period of time, right? Risk management is very important, and I would think it is almost critical. Exactly when at a time when you feel that because of your risk measures, your friends are going ahead in their return. So let me just explain. At a time when the market is booming and every share is going up, small cap, mid cap, large cap, everything that you buy is going up, or rather when you sell, you are looking more stupid, right? That's a time when you think, oh my God, why do I have so many constraints? Why do I have so much of risk mitigation techniques? That is exactly the time when you need risk mitigation. You don't need risk mitigation when the market is down, right? So suppose we'll talk about the Sensex. Suppose the Sensex is today 67,000 and it comes down to 57,000. That is exactly at the time in which you don't need so much of risk measures, but it is at 67,000 that you need more risk measures. So higher the market, the more that you feel that your risk is impeding your growth, that is exactly the time. So it is very, very counterintuitive. When you think you don't need risk measures, that is exactly the time when you need risk measures, right? And whatever people tell you, whatever economists tell you, there is nothing called a perfect inflation hedge. Sometimes it is gold, sometimes it is equity, sometimes it is real estate, and you feel, oh, I should have done this and I should have not done that. Then there is a theory which says put money in a multi-asset fund. All these things are covered. But the problem with a multi-asset fund is when equity is booming, your multi-asset fund won't be giving you great returns. They will give you adequate returns, they will give you moderate returns, but that is exactly the time when you feel tempted to say, oh my God, my multi-asset is not doing well. Should I remove from multi-asset and put it in equity because that is booming better? It is perhaps the reverse thing that you have to do. When equity is booming, you have to move money from a equity fund to a multi-asset, but the temptation is counterintuitive. You will want to do the reverse, right? I think Naren also spoke about in his speech. If you are a kind of a person who will get perturbed by your investments going up and going down, then you should be in a multi-asset fund, because a multi-asset fund will give you lesser standard deviation. But if you are a person who is chasing absolute return, somebody like me, then you should be in a fund or you should be in an asset class which has the highest standard deviation and your ability to sit through bad times, right? So 2002 March if you could buy, 2002 April if you could buy, then you're in good company, right? So then you don't need a multi-asset fund. So see what you need. There are so many products, maybe 4,000 odd schemes of mutual funds, largely meant to cater to different people. So do you need a multi-asset fund? It's your call. And it is not somebody else trying to tell you this is the best time to be in multi-asset. There is no such best time to be in any asset class. Time tells you at this point in time, like 3 years later, if let's say the index is at 1,20,000, I mean the Sensex, which means in 3 years the market has doubled, then the best place to be would have been your equity funds, because they will outperform your multi-asset allocation. Since we do not know about the future, and since we are a type who will panic when such things happen, therefore a multi-asset fund, not because it is the best fund, it is the best fund for you under those circumstances, right? Whatever you say, the rate of interest at which money is available matters. So having seen a 1980 to 2022 bull run in interest rates, which means the portfolios went up because the interest rates went down. It was a longish bull market in the world, US leading the way. We do not know how the market is going to behave with higher interest rates. See, interest rates were so low. Now with higher interest rates, we do not know whether it will come low or remain steady for a much longer period. That's the only question. Will it go up further from here? Maybe no. But will it remain steady here for a year or two and not go down at all? Is that a question? Yes, it's a question. Do we have an answer? No, we don't have an answer. Because if US does not cut interest rates, nobody in the world is going to cut interest rates. It takes tremendous amount of guts to go against the US Fed, right? It's the real big daddy in money. So interest rates matter. A friend of mine, 2020, he bought a nice big house in the US and logged in his interest rates at 3%. So I asked him, don't you think it will go down? He says it might go down, but 3% is something which I will always be able to afford over the next 30 years. And today it looks like a fantastic deal because the Fed is borrowing at a rate greater than what rate he has borrowed, right? So sometimes you can get lucky. But does he always got lucky? Has he always got lucky with real estate? This particular real estate has appreciated some 60% in the last 3 years. So to that extent, he admits that he is lucky, but largely he is an equity-oriented guy. But he says, oh, this house I got lucky. So sometimes you have luck, sometimes you have bad luck, but interest rates matter in your wealth creation journey, right? If you think there is any investment in the world which is risk-free, you are wrong. It means you don't understand risk enough. Every asset is risky. Equity is risky in the short run, debt is risky in the long run, right? So you go in and put in a hybrid fund, right? The multi-asset fund. So you do those kind of things. But yes, there is risk, which means the risk is two types. One is you completely lose all the money that you put, like you put in, say, Reliance Power, Anil Ambani type. So you lose everything. Then the second one is in the Mukesh Ambani type, when there will be fluctuation. Should Reliance be at 2,300, 2,500 or 2,700? Is it headed to 3,000? Is it headed to 4,000? We do not know. So variability, standard deviation is also defined as risk. So there is nothing called risk-free. I keep saying, look at the American GSEC, right? So the GSEC, which is supposed to be risk-free, is down at least 20% from its peak, especially even in forget longer term bonds, even intermediate bonds. So yes, it is down. So you need to understand where is the risk. In GSEC, the risk is in the interest rate. It is not in the default risk. I am not saying the US government has defaulted. No, that is not. The risk is interest rate risk, and that we have all seen. SVB SV Bank, right? So those kind of experiences we have had, we have seen. So there is nothing which is risk free. There is a risk. The only question is, if you think it is risk free, you are not perhaps not understanding enough about the risk. You are not smart because your portfolio has gone up. You are not dumb because your portfolio has come down, right? So, but when the portfolio is up, it's a great time to remove some money and buy some luxurious products, because at some stage you will feel, oh, I could have converted, right? So that's your call, but I'm just saying, you are not smart or dumb by what happens in the market. You are lucky or unlucky perhaps by what happens in the market. There are times when everybody loses money, like say March 2020, your equity was down, your debt was down. People were not willing to buy a 9.5% coupon Tata Power bonds, right? That is what happens to liquidity. Liquidity just freezes even in the best quality. It was a AA kind of a bond, but it was Tata Power. So Tata Power, there was no question of default, but 9.5%. There were no takers, right? It was difficult to sell a Tata Power bond. You could sell gilt perhaps, but trying to sell even a AA Tata Group with guarantees, no, it was not, you're not able to do it. So there is risk coming from so many places. You have to understand from where risk can come. It can come from liquidity, it can come from complete lack of transaction in that product, right? Or the government saying, no, mutual funds can't buy this kind of a product, therefore no mutual fund wants to buy your portfolio. So those kind of risks are there, right? And when everything is down, everybody loses money. The only asset class which was up was perhaps in the month of March, April 2020 was gold. And people were not willing to sell gold, right? So in your asset class, if you had a multi-asset fund which had gold, you would have suffered less. But in your real life, if you had gold, you could have actually sold. Theory, practically nobody sells gold, right? So inflation is unpredictable, immaterial of which part of the world. I did not think maybe 10 years back also that there would be a stage in my life when I would see inflation in the US higher than the inflation in India, right? We saw that maybe very briefly, but we did see that, right? Past performance is not a great indicator of future performance. This is what the mutual fund regulator SEBI keeps saying. But one thing is certain, your past behavior is. So I know a person who will sell at the bottom of the market and buy at the peak. So if I see him buying now, I would panic, and it's as simple as that. Not every time can you catch a top and a bottom, so don't worry about that. But one thing is sure, the past behavior is a great indicator of what you are going to do in the future. So yes, past behavior is. Too much leverage will one day come and bite you, right? So whether you are doing F&O or whether you are borrowing from a bank and buying shares, whatever, one day it will come and bite you, like it did to Anil Ambani. But like a Mukesh Ambani, if you know how to control the leverage, then you are much better off, right? When a thing happens, we knew, oh my God, I knew this was going to happen. That is not true. You're bluffing, right? So remember that. Also remember, like what John Templeton said, start with a prayer, it helps. And remember, investing is hard. It's not as easy as it looks. Thank you.